Good afternoon, everybody. Good afternoon, everybody. I am Andy Wettig, Executive Director of the Airport Restaurant and Retail Association. Welcome to our May Forum, where we continue the conversation to evolve a sustainable, resilient, and agile business model for the airport concessions industry. Thank you for joining us today. Before we begin a couple notes. First, we want to mark the passing of Norm Mineta, which was announced earlier today. As you know, he was a giant in our industry, a giant in the entire transportation sector, served in Congress, cabinet member under both Democratic and Republican presidents, and was widely regarded for his expertise in leading our industries. We will miss him and send our condolences to his family. Also want to note before we begin, a reminder to put your questions in the Q&A at the button on the bottom of your screens. And with that, as we begin the third year of the pandemic, passenger traffic is approaching 2019 pre-COVID levels, and the airport restaurateurs and retailers are enjoying a recovery in progress. The key words here are in progress. For the concessions industry is definitely not recovered. It has come a long way since the depths of the pandemic, but there's still a long way to full recovery. We continue to deal with accumulated debt, labor challenges, continuing airline disruptions, and high inflation. Today, we welcome two industry CEOs, Greg Paradis, President and CEO of Paradis Lagardère, and Michael Svagdis, Chief Executive Officer of SSP America, to discuss the impact of the pandemic on the industry, recovery, and the operating challenges of labor shortages, supply chains, and inflations. And we'll also talk a little bit about a new normal for airport concessions. So welcome, Greg. Welcome, Michael. Thank you for joining us today, and we look forward to our conversation.
My pleasure.
Yeah, thank you for having us.
So let's start with you, Greg. U.S. airport concessionaires lost upwards of 95% or more of their sales at the beginning of the pandemic, and then have slowly recovered over the past 2 years. How did you and your firm cover the losses?
Yeah, well, to answer your question, the short answer is we are still covering our losses. So we all took on a ton of debt. Our company took on well over $100 million of debt. Michael will respond in a minute. Our ACDBs also took on a lot of debt as well. So we are still paying that back. So it's going to take some time for all of us to pay it back, all that debt. So how do we cover it? You know, I'm proud of the job we did controlling the controllables. Much easier to say than do, because we had to make some very difficult decisions. Some of you have heard me share this. We went from 10,000 associates in early March of 20 from 10,000 to 2,500 almost overnight. So that was very painful. We furloughed those associates. And then number two, my entire team took big salary cuts, anywhere from 20 to 50% of their salary over a period of over a year. So we did whatever we could to stop the bleeding, or slow down the bleeding, I should say, to really survive, as we all did. So, Michael, anything to add on from your standpoint?
Yeah, you know, again, the debt's been the biggest thing. It's how we recovered. And we did everything that, you know, Greg and his team did, along with all of our other competitors. I mean, it was survival. I think, you know, as we look at the aviation industry as a whole, a big difference between us and someone like the airlines. The airlines had a lot of federal government relief. We got relief in the form of the MAG, that didn't pay to take care of all the debt. We still had to secure the debt. You know, the airlines, I know their debt's gone up as well, but they get significant amount of dollars compared to someone like ourselves to survive. And so that's why our debt definitely increased a lot more. And, you know, I think the biggest point that you really point out, Greg, is it's our joint venture partners in ACDBE. For them, their houses are on the line, different assets they have. And with that debt, it even puts more pressure and stress on them and for us to ensure that they're successful. So again, we're always really looking out for our partners, because it's critical for the whole ecosystem to be successful as we move forward.
Mm-hmm. Yeah, and Michael, big thank you to our airport partners. I'm sure you probably over 90% helped us in a material way regarding the MAG, or else it would all been out of business.
Absolutely.
Andy, back to you.
Yeah. Okay. Thank you, Greg. So, but where do we stand right now? What is the health of the industry at this point in time, where we are about 90 to 95% recovered in passenger traffic in the United States? But there are, of course, still some significant deficits in key travel segments. Where do you stand today, and how do you restore financial health?
Yeah, I'll grab that one first. So, as we got cash in the bank, but as we just talked about, the debt's increased, and now it's how do you invest wisely? We really need to be cautious with our investments, make sure we're going after good real estate. But the number one goal with those assets we have now is to drive sales and really make sure we get back to providing that great customer experience. You do that in the form of, refreshing our restaurants, make sure we're updating our menus, hiring the labor, which I know we'll get to later, and at the same time, building great new restaurants. We want to create a great customer experience, but of course, with the amount of debt, we got to be much more strategic and cautious about it. And again, the number one thing is to drive sales. So that brings cash in the door and helps us pay down our debt. But along with that, we have new struggles. We're right now finding people, which I know we'll talk a little bit about, and then inflation. So that's making that a little more difficult. But the good news is, again, cash is in the bank. We have to start working to do all those other things to get our debt down, and then continue just to invest in the business very wisely.
Yeah. Only thing to add, Michael, but really, and you stated somewhat, I'm sure you guys, like we and our competitors, are becoming much more disciplined and strategic as to the investments we're making and the investments we're passing on. And that is not to say we were not in 2019, but we've become much more disciplined, because it's a very challenging balancing act, because we still have debt to pay off, and we're still spending over $60-70 million in CapEx for new stores we've committed to. So the balancing act is how you take on new opportunities in addition to what you've already committed to. And then once again, it's hard to pass, because we know some of these opportunities may not present themselves for another 10 years or so. So that's what we're doing. And I'm sure our competitors are, because we all have limited capital. And it's almost like paying back two mortgages, the COVID debt plus the new investments we're making.
Good point.
And that's a very difficult situation to be in. And some of it comes also from deferred rents or whatever, where you're paying two rents as well, catching up on the stuff that was deferred, the rents that were deferred, and the rents that are current. So that means that the timing and extent of the recovery is really the critical and unfortunately unknown factor in many decisions in all of our conversations. I believe, though, Greg, that you probably have a slightly better recovery going right now because of the large share of travel convenience stores. And that probably has put you in a slightly better position. So how do you determine a recovery? What would you define as recovery, and what kind of measures would you look at to say, yes, we are recovered now? We are back to it toward a new normal.
Yeah, so recovery could be defined in a lot of different ways. From our company's perspective, Andy, I would define recovery. We will be recovered after our COVID debt is paid off. That's one of the key components, because when you're paying back the COVID debt, and then also you're taking on additional debt, that's challenging to overcome both of those. And then of course now MAGs are kicking back in many of our airports. So I'd say, when our COVID debt is paid off, from a total industry standpoint, Mike, I'll be interested in your perspective here. I'd say from an industry standpoint, probably at 90-95% of traffic recovery versus 19. You mentioned, Andy, that in the US, we're about 90-95%. There are the haves and the have-nots. Fortunately, Canada, I know, Michael, you have a big presence in Canada. We do as well, is finally come back now. So it's really good to see that, particularly from our workforce standpoint, because it was hard for them when they see the US starting to really come back, and Canada was lagging behind. They were very patient. We have great people up there. But I'd say from an industry standpoint, probably 90-95%, because most of our leases are based on assumptions that we're going to be at least 100% of 2019 levels. And when you're something less than that, that makes those leases very hard to work from a financial standpoint and get the return you had projected. Michael, anything?
Yeah, well, this is good stuff, Greg. The first one I'll start with is this. I mean, if you think about it, when we originally invest our capital, our expectations, we have growth year over year. We're going to have passenger growth year over year. You're going to have just a great job of like increasing your same store like-for-like sales. And if you think about it, so when we put deals in back in 2019, we expected growth in 2021, 22. That growth's gone. We assume anywhere from a 2 to 3% growth. So I really don't see us back to 2019. We lost 3 years there, which is, and we've got some extensions on leases, and that definitely helps. But that growth is gone. We're starting with a new normal, and then it's going to continue back. So that's the first thing. To Greg's point, we're trying to get that additional mortgage paid down.
Right.
That does not help. And I think a big one is the haves and have-nots. Right. You get the regional jet piece right now. There's a challenge. Excuse me. The airlines are diminishing their use of that because those pilots are disappearing. So there's some airports we're in right now. They're not back to 95%. Right. They're still sitting around 60 to 7. Then we have others, quite frankly, that over 2019 at the same time. But again, we assume that three years of growth in there. So 2019 is great, but we can't forget those 3 years we lost. I think it's super, super important. And then, I see recovery right now that we can continue to talk about it is when the labor market recovers. Because another thing that when we invest our capital and we do performance, it's not only the growth, there's an inflation that we expect as well when we do our financial performance. We all know that inflation surpassed that dramatically from a labor perspective and a cost of goods. So it continues to be more and more challenge for us out there. And, the last one I think is when it's recovered, and I know Greg agrees with this, we talk a lot about this, it's when we can get back to giving that great passenger experience. Right now, our focus, and I'm pretty confident it's Greg's and everybody else's, our other competitors out there, is we want to open as many restaurants as we can and retail outlets and giving that great passenger experience. With the shortage in staff, what will happen is we get pushed to open more restaurants and we don't have the appropriate staff, and then we staff them lightly and it's a bad experience. I can tell you right now, our directors of operations, they want to do the greatest job they possibly can and create a great experience. Most of our directors of operations, 10, 15, 20 years in the aviation industry and within the airport that they're in. It's their second home. So again, I see recovery not only from a financial perspective, but us being able from a labor perspective to create that great experience we were back in 2019, which I think is super critical for all of us because we want to have that reputation of that.
Michael, when do you think the recovery in labor will happen?
Greg,
That's $1 billion question, huh?
35 years. I've never seen anything like it. Never thought I would. I thought they'd all be coming back in droves. It's the biggest shock. And let's face it, you laugh. It's in the airlines. It's in the restaurant street side. I read the thing about CATSA today. There's huge lines up in Toronto. The chief executive officer of CATSA went out and apologized in public because he doesn't have enough people. Right. And so we have the same problem. So we have to be careful the balance of how many restaurants or retail outlets we open. And I want them all open, but to make sure we continue to give that great customer experience. It's super. That's another definition of recovery. It's just not the money. At the same time, it's the service we're providing out there.
Yeah, no, I agree. And Michael, we've chatted also just how we use technology to help really provide that first-class experience. And that's a balance because as we know, some travelers want the high tech, some want the high touch, some want both. And we need to make sure we offer the different options to the different customers, because one thing that has definitely changed, as I think we're going to talk about, Andy, later, is the composition of the customers. There's a lot of travelers who are traveling today that are not used to traveling or are very infrequent travelers. So I think we might be touching on that a little later. So anyway, I may be getting a lot out of order here a little bit. Sorry about that.
Well, that's quite all right, Greg, because it's a natural flow of things here. Is that you just touched on one of our topics that we had discussed, which is what are the big themes that you're seeing in the recovery? You know, obviously you've mentioned the composition of the traveling public at the moment, but then there's also some other possibilities, such as what types of goods. Has there been a marked change in the stores that they are visiting and making purchases from? And Michael, in your case, is there a marked difference in what types of food service they're looking for? And how are they spending time differently? So what are some of
In our
the
case as well, Andy.
I was
Yeah.
gonna say, Greg is in the restaurant business as well.
I should have,
Well said,
you
Greg.
know something? Yeah, sorry about that, Greg. Since I
Do
came
not
one
worry. I'll
time
pay you
from
back
that.
later, Andy, on that one.
Go ahead, Greg. Go ahead, Greg.
Yeah.
Well, it's interesting. I travel every week, Michael. I know you're traveling every week now. And I travel every week just to stay close to business and see the truth out there. And it's very interesting as you travel to see, of course, what we've seen since the beginning of the pandemic, the leisure customer, the business leisure together, lack of international, though that's picking up, the ultra low cost carriers, the ultra low cost customers, UCCs, which buy differently and have different habits and need a little more maintenance in some regards. But as we all know, they drink a lot, which is good. So what's happening is this is also changing among concourses. So we, airports, airlines have and must become even more agile to adjust sometimes on a daily basis to the difference as they move flights around. So that's, from a customer standpoint, the business traveler, just over the last few weeks, I see that increasing. Not dramatically, and based on reading Delta, but I'm not sure where it is here in Atlanta. But it's probably gone from 50% to 70% of where it was in 19, approximately. Once again, sometimes it's hard to tell who is a business customer and who's a leisure customer, just the way people travel. But we see that with the spending piece, Michael. We see it with per diems, how important per diems are in the food business, of course. Just to answer your question a little more specifically about retail, Andy, what we have seen since the beginning of the pandemic, and this has only accelerated, is the importance of snacks, beverages, grab and go product, technology products, electronic accessories. That's what's really driving the growth. And it's like we've never seen before. The grab and go business has exploded. Travelers want to eat quickly. And of course, some of that's due to restaurants being closed. As far as restaurants, Michael, you could add on to my comments. The QSRs are what's driving the business right now. They're less impacted by the business customer versus the sit downs. Bars are doing quite well, as I alluded to earlier. It's interesting. Some of our local, what we're seeing in airports, some of the local branded restaurants have gone out of business on the street. So we need to make sure they continue to evolve in an airport. So that's not easy. So those are some of the, to answer your question, as far as the retail and food and beverage changes we're seeing.
But before you go off to you, Michael, Greg, have you noticed, you mentioned the accelerated purchasing of, grab and go out of the travel convenience stores during the pandemic. Has that changed? Has that diminished a little as the restaurants have reopened?
No, from our standpoint, I know. Well, first of all, of course, traffic's increasing a lot. So we look at it as a percentage of our business in a travel essential store. So it is still growing rapidly. We've worked hard to offer a better assortment, because that's what, offer what the customers want. And the customers are quick to tell you what they want. And it's in our business, with increased velocity of the business, it's very easy to now with the traffic to see what's working, what's not working. But no longer are customers satisfied or travelers satisfied with a convenience store sandwich. They want a good quality sandwich that's not been on the shelf for 7 days. So once again, that's been our focus. And where we do both food and beverage and retail in an airport like Oklahoma City, for example, we do not see any cannibalization of the business. The traveler wants what he or she wants fast and now, and a lot of times they do not have time to shop in more than one unit. And the other thing that's happening in some of our connecting airports is the connecting times are getting shorter. So speed of service is critical. And of course, technology plays a key part of that. Michael, are you saying similar?
Yeah.
Yeah.
I'll piggyback off some of that. So going back to where Greg kind of started off and then we got into the subject is technology. So we have been executing technology very quickly, order at the table where you can use QR code to order, pay everything else, virtual kiosks. And it's kind of interesting. We've been seeing, so our percentage of digital sales have gone up. Even though we've gotten more, I'll say digital or more technology out there, we're seeing it flatlining because I agree with Greg 100%. You have certain passengers, they still want to use technology. Okay, they want a real menu, they want a real person, they want to talk to somebody like that. Now, granted, I said this once before, I forget what a conference it was at. I go out to eat with my wife, myself, my 3 children. The kids are perfectly fine, QR code, technology, whatever. My wife and I love the menu. And we want to talk to a server about the food we want. So we see that coming back, and it's a mix of passenger that's coming back into the business. I think it's that elderly passenger, maybe wasn't traveling as much because afraid of getting COVID, things of that nature. So our digital sales are flatlining. Again, even more we have out. Another one is speed of service is a big one. We have done well in our casual dining restaurants, bars, and QSRs. It's a big focus of ours. But going back to investing capital, one of the things we've focused on is not only our menus, we're redoing our menus to make sure they great quality food, but great speed of service, but reinvesting in items behind the scene in our kitchen. Because I agree with it, is one of the problems we're having because the airlines are banking a lot more flights. Because before, we're having we used to have, let's say a small valley between the 2 peaks. Those valleys are getting wider and wider. Therefore, you're getting, a lot of people in the airport a short period of time. That's why they're looking for that speed of service. So we're revisiting menus and casual dining and bars to make sure we can execute quickly and at the same time do it from a kitchen equipment perspective to do it quickly, which I think is super important. And we're seeing in some places, the average check could be flat or a little down. It's more of that airport, I'll say gates or airports that have a bigger focus on the business travel and the international travel. They tend to spend more money than an ultra low carrier or just someone for some leisure travel. So in some instances, we're seeing a lower check average based on the change of the consumer demand. And the last one I'll say is comfort foods were really big. People wanted it. COVID was around, people depressed. We're seeing the trend coming back from 2019. They want customization. They're getting away from the comfort foods, looking for some lighter fare. So again, working on that as we work through it, exchanging menus, as we call it, menu optimization to make sure we're meeting the customer demands.
Mm-hmm.
Yeah, Andy, just one thing to add, to Michael's comments. It's interesting, you think about technology as just replacing the service, where you don't need an associate. The reality is what we've seen, we do a scan, pay, and go technology. And in a very high volume store, I think it's an $8 million store in one of our hub airports, is Travel Essential store. If we put a greeter in the front of the store to help the person, first of all, you can put all the signage in the world you want in stores. People are moving quickly, they may not see it. When we put a greeter out there, I think we did over 20% of our business on a busy Sunday with a scan, pay, and go, which I never thought would be the case. And just put that in relative terms, that was probably $3,000 that day in that store. That some of that was incremental because these are heavy push periods, and when there's a line, people just walk out. So that person is still important, but instead of helping one person, that greeter could help 3 at one time because it's very simple technology. Even I can use it, as I say, and I'm not great with technology. So I just want to add that point where that touch piece is still important sometimes with technology. Right. To make sure the customer who's in a hurry understands how easy it is and how efficient it is.
Let me go back because you both mentioned airlines and connect times and all that. Airlines, of course, have been doing all sorts of crazy stuff to their schedules over the past 2 years and their flight structures. As earlier last year, we had a regular segment on these forums about the airline news desk, and I've started characterizing it as routerama, as they would just be making new announcements every few days, it seems, of new cities that they're going to. And Southwest opened up some, dozen or more new markets, new cities during the pandemic. How have these frequent changes in the flight schedules? You alluded to the connect times being shrunk. You've alluded to some of the RJ-oriented markets being shrinking passengers. But how about just the constant changing in the schedules? How has that affected your businesses?
You want to? I'll grab.
Yeah, why don't you start, Mike?
Yeah, it's made it very interesting. So as I kind of mentioned earlier, our operating hours and what restaurants we have open are changing constantly because of that. Our number one goal, as I keep mentioning, is a great customer experience and driving sales. Most of our business is unionized, so we have bid schedules. Those bid schedules are very specific to what restaurants they work in, what hours of the day, what day. And when we have to change those, in some states, you absolutely have to ask for approval because the law is there for the employee that we can change a shift. And when we change the shift, we actually pay a penalty. Even if they agree to it, which is amazing. You may sit there and shake your head, but I don't know if you all remember that got passed in the state of New York in quick service restaurants a few years back, right before COVID started. So it creates a lot of scheduling complications for us to meet the demand, because we immediately are on the phone. We're changing hours of operations when people are coming in, because we can have them come in. If the customer's not there, it's not good for anybody. Again, with the shortage of labor, we want to make sure they're at the right times to give great experience. So that is a big one. I did talk about the banking of the flights already, some of the things we're doing with that, but it is definitely gotten, I don't know if the word's worse, but it's increased, that valley's gotten much bigger, as I mentioned earlier. So again, that is all about using technology, but it's not all the answer. Looking at your menus, changing menus to make sure that they can be quick cook times and quick preparation times, because you want to get the customers in or out. But another thing happens when you do have Southwest all of a sudden show up, or a Spirit or a Frontier. It's a very different passenger. You then have to start saying, how do I change my menu? What do I change for my grab and go items? Again, everything changes in your restaurant because that consumer is different. So it brings constant change. And if you think about it right now, every one of our airports just about is not at the labor that we'd want it to be at right now. So you're short staffed and you have tons of change going on because the airlines are bringing change, which just brings more stress and makes you harder to execute a great customer experience. So that it just creates challenges. We're working through all of them. You try to keep everybody calm. You have, we call it the support center, DC, support them, but it just brings change, which brings a lot of challenges with it.
Yeah, I mean, the only thing to add, I do like routerama, Andy. I don't know if you coined that phrase, but you should trademark that. We use the term chasing flights, and really that started out at the beginning of COVID when flights were changing so quickly, and one day a concourse could have flights and the next day there were 0 flights. And our team real proud of how they were agile to do so. On the food and beverage side, that's harder because of the kitchens, et cetera. But I would tell you what, this will continue, and that's just the world we live in and will continue to live in. So it's an exciting challenge, it's a stressful challenge on our team, but also for some of our ACDB partners who are subtenants, that creates a lot more stress, because all of a sudden that store could be relevant, and then the next day it's not relevant. They have a MAG, they still have to pay it, or somebody has to pay it, they have to pay it. So I think as you talk about one of the challenges around minimum annual guarantees, I know this session is not about that, and how to structure contracts, how to make sure concessionaires have scale, so they're not only dependent on one airline. So if that one airline goes out of business, that tenant could be out of business. So once again, this is this is really showing one of the, I would say, potential challenges we had in 19, but it's becoming more relevant even today. So I just want to add that, Michael.
Good stuff.
That is a good point. I mean, those are some of the challenges we all faced designing programs and laying out programs back in the good old days when there was none of these concerns about traffic fluctuations and all that. Is how do you make sure joint venture partners or subtenants have viable businesses, and that everybody has a viable business. We've all touched on labor, and we've all said we're coming back to it, so we'll come back to it now. How short are you of where you would like to be? I mean, as a percentage of your say desired staffing, how short are you, Greg?
Yeah, and
Percentages.
yeah, so it's two things. You have a certain number of openings, and then also to be at full operating hours. So when you look at it, we're probably I mentioned we've gone from 10,000 to 2,500 as COVID hit. Now we're at 8,000, and we could probably be at 9,300 right now to be fully staffed. But of course, this is changing as we go into peak seasons, peak summer seasons. We're extending hours, and now we're ramping up even more so. So we're 10-15% short. With that being said, our managers are doing a great job picking up the slack. With that comes a lot of concern as far as burnout. I know Michael and I were talking about just some managers who've taken leave of absence for personal reasons because they are just totally burned out, which is not healthy, but they are picking up the slack because that's just what happens when there's not as many people. So that's how short we are. We're all paying, our wages are up, depending on the market, 20 to 40% from last year. And last year they were up as well. So we're all doing similar things to get employees. And, it's really important. We're always talking about recruiting new employees, but what is even more important is retaining your good employees. So we spend a lot of effort on that. We have our regional directors in this week here in Atlanta talking about what else we could do there, because that's the core. These are the 10, 15, 20, 25-year people we have who are the ones they're stable, and with that being said, they're being recruited, with higher wages, et cetera. So fortunately, I'm proud of the culture we have and, the family culture. So these people feel like they're part of our family, not just working for a company. With that being said, we're not perfect in regard to that, but that's a key part of, retaining these existing employees and working with our airport partners who've been great to create an airport community that people want to be part of. So it's so interesting. I was in Canada with Nikki Harlan a couple of weeks ago. In two of those airports, I think the Canadian airports have done a really good job creating an airport community where they're proud to work in the airport and they want to work in the airport. And part of that is they offer other services, whether it be daycare, pet care, and other benefits, which you will get in the private sector. So I think one of the challenges, Andy and Michael, you could add is how we work together to create that airport community and do things differently. So for example, we've talked to airports about marketing funds that we all contribute, whatever the number is. Well, maybe we need that for retention programs for these key employees or other recruiting measures or other recognition measures, because these cost money. I was at one of our airports a couple of weeks ago as well, and they said, what is it going to take, to get fully staffed, and how can we help you, and how can we help each other? And it's interesting where they're willing to participate 50-50, 75-25 to retention program. And when I say retention program, where there's significant retention bonuses if our associates stay through the rest of the year. Okay, so how do we do that together? So it's, once again, thinking about our business, not how we've done in the past, but how we need to do in the future together. So I know I've rambled on a little bit, Michael.
That's
You think
okay.
Yeah.
Greg, you tend to do that. It's all right. Don't worry about it.
Why should they be
It's your
any different?
passion. It's your passion for the industry. I
Okay,
love
sorry
it.
about that.
No, I'm just, Greg, come on, you know, I'm just having fun.
Exactly.
So you said something, Greg, it struck home. Greg's right. We lost, not lost yet. They've asked for a leave, 3 directors of operations that work for us. So that's the main person at airport, all with over 10 years of tenure with our organization. That just said, because their mental health and their physical health, after 2.5 years of this, we want to step down. I'm going to take 6 months off. I'm going to take a year off. And it's not like they have the financial well-being to do that very easily, but it's super important to them. And that's the problem with labor is creating. It's creating the stress across the business, and you can only do things so long. I mean, Greg said it well. It's all same thing in our company. Our managers are really stepping up because we're probably about the same 15 to 20%. And again, it's depending upon the market. Some markets, we're right where we need to be staffed. As others, we're still 40% down because the unemployment rate's 2% in that city or state, and it's very difficult. So the mental health is definitely a challenge, and we all know it. I mean, it's kind of interesting. We always talk about the challenges to work in an airport, public transportation, the badging process, the fact you have to get badged at all, the background checks. That was a challenge pre-COVID. It's become a bigger challenge because of the labor shortage. And I know we all get that, but it's a much bigger challenge because we're seeing huge turnover, right? And we're very compliant on our onboarding and orientation because you want to get people on board right. We're at a 97% compliance, big focus. I know Greg's doing the same because we want to keep them if we get them. But they immediately just get a job offer street side and they're like, wait a minute, I don't have to get on a bus. It's close to my house. I don't have to stand in the TSA line, all the things we all know. And now that there's such a shortage of people, boom, they're gone. And we do compensation comparisons in every market we're in. We're doing them constantly. We used to do them once a year. It feels like every month right now to make sure we're competitive. And we're doing the same thing. We're doing sign-on bonuses, retention. We got big retention bonus plan coming up this summer because we don't want to lose anybody to catch all the passengers. But you know what? Street side's doing the same thing. Our street side restaurants are doing the same thing. And then we have this challenge of trying to get to the airport because we have some airports that don't have public transportation. And we pay for parking. We pay for public transportation, T passes, all those things. We're doing all of that. And it's still difficult. And that sometimes we really need to, be thinking about. It's sometimes people will take out the leases and say, I want everything open. I need all the operating hours. We do too. And I mentioned it earlier. We can get everything open, but what's the experience going to be? We got to make sure we balance that until the labor market comes back, because I can assure you, it's not about us not wanting to pay the person the right amount, because we're willing to do that. I think an average cook for us right now, their average salary is at $5 an hour. A cook for us, $5 an hour from a year and a half ago. Think about that. They're $25, $26 paid employees right now, and they have all the union benefits. They have great PTO. They have great medical benefits and all that, which again is another thing we're marketing because street side's not as good. But again, we're losing them.
Yeah, Michael, to your point, just the challenges of airports and how you convince a new employee to wait 3 weeks to get badged.
Yeah.
That's a tough sell. We've been losing a lot of people that way. Some cases in these really tough markets, we're paying people the day we hire them.
Yeah.
So they stay.
Do that.
I do want to commend many of our airports who have really, I call it attacking the wedge of how we could speed that up together, recognizing there's a lot of different hands in the pot as far as badging goes, and we all want a safe airport. But I've been pleased with many of our airports have stepped up to really not solve the problem, but reduce that time, because that is critical. This wait time is critical.
One last thing I'll add, because this is the new thing, because again, we're calling employees, we're doing surveys when they leave because we want to know why they're leaving. And the big one, quite frankly, is flexibilities and schedules. Again, we're heavily unionized. We have a bid process. We have to put the bids in. There's certain schedules that go out there. And there are those schedules people don't like. It's 4:30 in the morning. I got to work on Saturday and Sunday. That rotates every three through. So what happens is that most senior employees been there otherwise, picks the best schedule. I'm a bartender. I'm going to pick this best schedule. What happens, that new employee that's coming in since the less tenure, they don't get the most favorable schedule. If it doesn't fit with their life situation, we can't change it. Not that much. The flexibility isn't there. If you're street side, you can move people around because you're not unionized, which creates another challenge, because that's one of the things we're hearing is it's a tough schedule. And I didn't realize this is schedule work, and I have daycare, and I have these different challenges.
Right.
I have another job, and here's some challenges I need to work around. But the unionization piece really prevents us from doing that, and takes away all that flexibility. Yeah.
So plenty of challenges that we're facing today, and likely to face through much of this year and into next year. But in the last few minutes that we have here, let's chat a little bit about what are the more significant long-term impacts from COVID on the industry. Some of these things are here today and presumably will grow out of some of them, perhaps labor shortages. But what about labor will stay and continue to affect the industry? Or what about inflation or some of the airline changes will you foresee staying in place and affecting how we recover for the long term? I know you had some ideas about that, Michael. So,
well, the big one is going to be is just cost of construction. I don't see it going back down. We're 25 to 30% up. It's just amazing. The other thing which I think will stop is the lead time on equipment. Typical equipment we'd order, we can get it in anywhere from 4 to 6 weeks. It's 36 to 48 weeks now. It's amazing. I started construction on my house August of last year. I'm still waiting for my appliances. They just told me they're going to see them in June. And the kitchen's done, so it's kind of, and it's everywhere. The supply chain issues will be interesting to see if that gets better. I think it will. Depends what happens in China. And of course, Ukraine, very concerning. Hopefully that all just kind of calms down, which I think is going to be important. But I think the benefits, the cost of an employee, the benefits cost of an employee are here to stay. They've gone up. You can't turn it back. It's not going to get turned back. So those, going back to the cooks and paying, $25, $26 an hour now, that's not going to go away.
right.
And what I've seen, which is perfectly fine, we're in a unionized environment, is the unions have gotten stronger because you could see the Starbucks thing, what's happened there, and different things, which is fine. It is what it is. But what brings that is extra costs for our business, which will come with that, which I think is going to be a permanent change in our business. So those are some of the ones for me. Yeah.
Yeah. Not to be repetitive. So those are the challenges, challenging impacts, long-term impacts I see as well. We're not, from a union standpoint, we don't have the concentration you guys have, Michael. But also I do want to stress some positive impacts, long-term impacts, because I think that's important. Because I think there's a lot of positives that's going to come out of the last 2 years. One is collaboration. Yeah. Mike, I'm sure you've seen it with your airport partners and airline partners. The collaboration level really improved significantly during the pandemic because we all had to survive. And I think it's continuing still positively. I think we're losing a little bit of that momentum, but I still think it's a positive long-term impact because we all now understand each other's business better than we did before. So I understand the airport's business better. They understand my business better. I think we understand the airline's business better as well. Another impact, I think positive impact, is going back to, Michael, what you were talking about, the traveler's experience, where a lot of airports were talking about the traveler's experience, airlines, concessionaires, but today it's real. We are focused on the traveler's experience. And as long as we stay focused on the traveler's experience, we'll do our jobs. And Michael, to your point about leases, a lot of these leases were written 5-10 years ago. Yes, they're relevant, but at the same time, they need to evolve to what's best for the traveler's experience. Examples is use rights, and And once again, it's not being fair to every concessionaire. I tell our airports, just let us all give the traveler what he or she wants. We're fine with that. We'll all be better off. The pie will get bigger. So I think, that is, in airports are thinking that way. We call it the growth mindset, where you think about how things should be done versus how they've been done in the past, or how at least states they should be done. So once again, a lot of positive impacts. You've heard the term many times, don't waste a crisis. And I think our industry is not wasting the crisis, but we cannot forget the learnings of this crisis, because it's easy. I remember back with the Great Recession, it's easy to go back to old ways quickly, whether it be mags, rental agreements, which now are, it's black and white. This is the way it is. Well, let's once again be focused on the traveler's experience and make sure we're doing everything to support each other to make that traveler's experience better. And in turn, the pie will get bigger, customer satisfaction will get better, customers will be more apt to travel more, even at higher prices. So we really haven't addressed that piece. Airfares, as we all know, are up 30-40% this year. It's gonna be interesting to see the impact. So with that, customers have been more tolerant of the stress in airports and long lines. Well, as you pay higher rates, they will become less tolerant, in my opinion. So once again, those are a few things to add to Michael's comments.
We've run over a couple minutes here, but a question has come in from one of our listeners, or viewers, a relatively small airport, he says. He's wondering if you are encountering specific challenges and successes in smaller versus larger airports as you go through this recovery. You've got both of you have very wide ranging sizes of airports. So Greg, why don't you?
Yeah, I mean, I'll break it down into a few categories. Yeah, typically in our smaller, medium-sized airports, staffing challenges are not as severe. There are exceptions to that, of course. So that makes a huge difference, because everybody, I'm sure, Michael, you got to ask this question: what are your top challenges? And of course, staffing is one. I say staffing is not only one; it's 1, 2, 3, 4, and 5. Because that cures a lot, and that's the truth. Other differences. What we're a little concerned about, I know some medium and small airports are concerned about, is the impact of the pilot shortage on smaller, medium-sized airports. We've not seen it much to date, but that could happen more this summer. I just read where Southwest is cutting 2,000 flights this summer. A lot of the airlines are reducing their flight schedule. And what will happen, I believe, is that will impact small, medium-sized airports more. So those are some of the differences. I think the biggest difference is staffing challenges. Of course, smaller airports and medium-sized airports are easier to navigate, just in essence because they're smaller and medium-sized airports. And typically we have our warehouses on site versus off-site. Michael, anything to add?
Yeah, it's almost identical to what Greg said. Staffing challenges, not as much. A lot of time, easy to access. Badgings tend to be much quicker in a small and large airport, because there's not just a huge flood of people trying to get badged. It's not as complex. From a food and beverage perspective, right now, currently, you can have some supply chain issues, because if they're in a smaller market, that distribution center doesn't have the same volume. So maybe Dave, and I'm going to pick an item, like French fries, they just don't have. And it's because there's so much demand, and they only get so much supply because they're on the low totem pole, and they're a very, very small distributor. That would be the key differences. So again, staffing easier, sometimes supply chain issues. Yep, a little more worse than somewhere else right now in the larger.
Great. Well, gentlemen, this has been very, very informative, I'm sure, for everybody. It certainly was for me. Thank you very much on behalf of our whole audience, as well as the Airport Restaurant and Retail Association. Thank you, Greg Paradis, and thank you, Michael Zvagdas, for joining us today and sharing your insights and experiences as we recover from the pandemic. And thank you, everybody out there who joined us today, or viewing or listening in on the phone. We hope you had a good and enjoyable as well as informative session here. So Michael, Greg, thank you very much Thank you,
Thank you,
everybody,
Andy.
and
Thank you.
have a
Thank
good
you,
day.
Andy. Thank you, everybody. Have a
Great.
good day.
Thanks a lot,
Thank you.
everybody.
Andy, thanks for leading the charge for ERA. We appreciate it.
Well, thank you, Greg.
I know you have a lot of
appreciate
bosses now.
that. I do. Two of them are on this call.
No, seriously, thank you, Andy.
Thank you, Andy.
You guys are doing some
Good.
really good work, and it's very, very important for our industry.
Thanks a lot, Greg. I appreciate that.
Thank you, guys.
Thanks a lot, everybody.
Bye.
Have a good day.
Take care. Bye-bye.